we witnessed a bloodbath in the metals market. So today I'm going to be talking about that. I'm going to be telling you what caused it and why people might have got it wrong. I'm going to tell you what comes next, or at least what might come next based on historical precedent. Silver fared even worse. Spot silver was down an incredible 26.44%. I think I've got to repeat that. 26.44% down in one day, or $30 in a day. But the futures, the near-dated futures, down $35.90. That's more than silver was worth 6 months ago. That was a drop of 31.37%. Nearly a third of its market value was knocked off in one day. Look at that drop. Gold was down 8.99%, ending up at $4,893.59. A drop of 8.99%. Call it a drop of 9% for simplicity. And the futures, the near-dated futures, fell even further. They finished at about $150 below the spot price, down $609 on the day, or 11.39%. Platinum didn't fare any much better, down 17.2%, or finishing at 2150, and palladium down 16.25, ending at 1682. In Shanghai, the futures price dropped $21 or 16%. But I think we can't look at any of these prices and regard them as real, because these prices are going to bear no resemblance to what we see on Monday. On Monday, we might see a further fall, or we might see an extremely strong rally. The ETFs that track these metals also fell and felt the full force of the blow. The popular iShares Silver Trust, the symbol is SLV, lost 31% of its value, even more than the spot price of silver. But another one which really, really hurt was the ProShares Ultra Silver Fund. That cratered by over 62%. So beware of leveraged funds. They can move far further and far faster than you can imagine. It was one of the worst days on record for both.
Silver crashed 26% in one-day gold, down 9%. A new Fed chair triggered panic-selling stop-losses caused a domino crash, but I studied 130 years of market data and found after crashes like this, markets go up twice as often. Silver has crashed 96 times since 2000 and rebounded 64% of the time with 38% average gains. The fundamentals are still strong.
But silver is rather different. Silver tells us a completely different story. A 5% or greater single-day crash is not an anomaly. It's a regular feature of the market. Since 2000, the year 2000, silver has experienced 96 crashes of 5% or more. So those who are in silver have had a stomach-churning time over the years, most of which they've forgotten, but on 96 occasions they've seen 5% falls in silver or greater. And of course, yesterday was probably greater than any of those falls ever. Let's see how silver performed after those 96 crashes. And I'll bring that up here. Where we were on it, sorry. Yeah, there we were on it. So, by the way, these figures don't always add up to 96 because some of the returns after 1 year were zero, so they're neither positive nor negative. But we see that after 1 year, after a crash of 5% or more, silver was up 56 times and it was down 32 times. and the average gain for the up moves was 38%, obviously clearly exceeding the size of the fall. So silver definitely was a much more volatile asset and generally recovered, not always, because there were like 1 out of 3 chances that it would fall, but 2 out of 3 times it recovered, and recovered very, very strongly. So the pattern is clear. The longer you hold on after a silver crash, or for that matter a gold crash, or for that matter a stock market crash, the higher the probability of a positive return, and the longer you hold on, the more powerful that return is likely to be. Let's put it another way. It's always a good move to buy after, or not always, it's more likely to be a good move to be a buyer after the crash, because quite often the crash represents a situation where the metal has been oversold. So 1 year later, after a crash, silver was up 64% of the time, with the average up move being 38% after the crash. So what happened? Why did the market suddenly panic and sell all its gold and silver? Well, President Trump announced his nomination of the next chair for the Federal Reserve. His name is Kevin Warsh. He was a former governor, and he has been seen as a sound money person because of the fact in 2011 he resigned from the Federal Reserve. Why? Because he didn't agree with the quantitative easing, QE2 it was known as at the time, and he felt that this would be inflationary. So you can see, based on that, a lot of people see him as a hard money man, because looking at some of the things he's said since, my conclusion, and I won't go into too many details here, but my conclusion is that he's a person who tends to follow whoever is in power at the time, and he has made some statements which you can read about if you Google it, but they make me think that he's not at all going to be hawkish, but rather could well be very dovish and support lowering of interest rates, something which even President Trump has said he expects that he will be lowering rates. Trump says he agrees with him that rates should go lower. But that's not how the market saw it on Friday, because they didn't know that. They perhaps hadn't got time to read up on him. Because of the incredibly huge rally, we'd had more and more people coming into a crowded trade, buying gold and silver. They were short-term traders. They'd come in. They were putting stop losses to prevent them, to avoid them losing more than they could afford to lose. And once one stop loss gets triggered, that pushes the price lower, which triggers the next stop loss, which pushes the price lower, which triggers the next one, and so on and so forth. And to add fuel to the fire, when this sort of thing starts to happen, there are some big boys who come in to effectively short the market, because they know the price is going lower when they can see they've got visibility on all these stop losses. They can say, oh, there's one there, one there, one there, one there, one there. All we have to do is sell into the market. We'll trigger all these stop losses and we can buy back at a lower price. So these stop losses cause the market to cascade into, like dominoes. One domino knocks over the next one, and it goes, it's a downward spiral. But of course, there are people profiting from it because they know exactly where those stop losses sit, and they can sell at one price and expecting to buy back when all the stop losses are triggered, and they can buy back and make a profit. So when you've got these upwards movements like what we have seen, kind of a parabolic move, you get more and more people putting in very, very tight stop losses like hair triggers, and the slightest decline can trigger them all to go off at the same time. And that's what happened on Friday. So the shockwave from the metal markets was felt across other markets too. Stocks took a little bit of a hit. It wasn't much. The Dow Jones Industrial Average and the S&P both fell by 0.4%. Now, I have taken the time since first thing this morning. I've been up first thing this morning and I've been studying until now. It's now nearly 8 o'clock in the evening, European time. I've studied every single crash, every single day crash in the Dow Jones Industrial Average since 1885. Now that's 130 years of history and more than 38,000 data points. I also looked at every single crash in gold and silver, although on that I couldn't go back nearly as far as 1885 with the Dow Jones. But I'll get into the gold and silver shortly. But let's just start by talking about the fact that my conclusion as to what's going to happen is the same whether it be stocks or precious metals. They both tend to behave in the same way after a crash. There were more gains, typically twice as many upsides as there were downside periods. Now, that's 2 out of 3 chance or probability that the next move is going to be up as opposed to a 1 in 3 chance of down. But of course, it's still rolling the dice. But we can see that on average, if we go to the 1 year mark, at the 1 year mark, there were 62 occasions where it had risen strongly and only 23 occasions, 1/3 as many, so where it had fallen. And on the 62 occasions, more than 2 out of 3 times, the average rise a year later had been 38.22%. But that doesn't tell us with certainty what's going to happen on Monday, but it does tell us where the probability tends to lie. At least we were looking at the stock market there. So this is not looking at the precious metals market, but it provides some sort of historical analog of what happens after crashes. It shows that historically sharp and violent crashes have often represented a buying opportunity. Certainly more often they were a buying opportunity than a signal to run for the hills. In other words, did it make any sense to sell after a crash? Well, the answer is no, it didn't, because the odds were in your favor that you'd have a strong rally pushing back to a much, much higher level than the point from which you fell. But that's still 26 years of data, nearly. And it's 6,300 data points I could look at for gold and silver. And I identified every single day where gold or silver crashed by 5% or more on the day. So typically that would be a move of 5 to 10%, in line with what gold did on Friday, down 8.99%. So I tracked every single movement where there was a crash in one day of more than 5%, and then I tracked what happened to the precious metal, gold or silver, in the days and months which followed. And the results are quite fascinating, but actually there's a stark difference between the two metals. So for gold, a single day crash of 5% or more is an incredibly rare event. In the 25 years of data that I could look at, it only happened about 10 times. This tells us that gold is, relatively speaking, a far more stable asset than its volatile cousin silver. Let's just have a quick look at how that did. So I'm going to go over here and bring up there we are. This is gold, and I'm looking at what happened 7 days after a 5% crash, 31 days after a 5% crash, or 1 year after a 5% crash. The reason these figures don't all add up to 9 is in one occasion, the difference was actually 0%. But what we see is after 1 year, there were 3 times as much probability, 3 out of 4 probability that the price would rise. I've gone to the wrong sheet here. Let's go back to that. There we are. Now, that's only 6 versus 2. So 6 rises or 2 falls. It's not a huge and statistically significant number, but it does tell us that it was historically more likely to rise after a 5% crash than fall. And on average, gold was up 13.99% 1 year later, more than recovering the fall. So what's the future for the precious metals? Well, if we look at the analysts, they're pretty divided. The bull case and most of the fundamental reasons for owning precious metals haven't disappeared. Geopolitical uncertainty remains high. Many countries are looking to diversify their reserves away from the US dollar. Before the crash, major banks were calling for gold to hit $6,000. Deutsche Bank, SocGen, for example. They were talking about 6,000 in 2026. And on silver, they were forecasting higher prices too. Citibank, for example, were forecasting that silver would get to $150. So I haven't yet seen what they've got to say about it, but I've seen a number of comments, and I think the general comment is the correction we saw on Friday, and we're calling it a correction, was an understandable correction after such a long bull market. And all bull markets climb walls of worry, and corrections are part of the makeup of every bull market. So will this bull market continue? And is this just a correction on the way? Or is it telling us that it's all finished and it's never going to get back to those levels again?